Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special returning guest is Akhil Patel. Akhil Patel, welcome back to the show.
Thank you so much for having me back. It's been a while.
It has been a while. It's been longer than I thought it should have been, actually, because I had a conversation with Phil and we hope to get you straight on after that. But as time flies, that I don't know where it's gone. We're already at the end of January. Tell us about your 2024. Think did things pan out as far as you were concerned and what you were expecting in the markets?
Well, I think you know, Paul, that we publish an annual annual stock market roadmap at the start of each year, and it was sort of calling for stronger second half of the year than the first half, and we had a sort of a shape of what we expected the Dow Jones to do, and we use the Dow Jones because we have the most historical data, and obviously, being a cycles person, the more historical data you have, the better. So we felt it would be a strong finish to the year. We thought that it would be up into the end of the first quarter, then it would be sort of sideways and down a bit in the middle part of the year, and then sort of setting the scene for the strong finishes I've mentioned. And I think it's exactly what we got. So from that point of view, it's pretty good. We also felt that consistent with the kind of 18-year cycle thesis that I've talked about in previous appearances on your esteemed podcast, that we're sort of approaching the final frothiest parts of the cycle where you would get a lot of kind of crazy behavior and a lot of hype, and a lot of tall buildings or plans for tall buildings. And I think we got quite a lot of that. I mean, it doesn't necessarily. It might appear different depending on where you're located in the world. But if you, I think, take the sort of outlook from a fairly global perspective, I think you've seen a lot of that sort of thing. If you go traveling around the world, I mean, there are places going absolutely gangbusters. And I think that's all fairly consistent with the main thesis of the cycle. And it's quite interesting to see how it's playing out. Obviously, with the sort of specific variations that you get each cycle. So this year it's sort of very tech heavy. The kind of forms of entertainment and hedonism and excess take quite a different look to previous cycles. But it's quite interesting to see what's going on at on the surface, and then try and relate it back to the kind of principles that drive the cycle, which I've tried to outline in my book for readers as they go.
Yeah, so for listeners who may be new to hearing about you, you first came on the podcast, I think it was in 21, and you made an outstanding call that the property market wouldn't go down, even though we're in the midst of the COVID madness and landlords were looking to get lumped with a load of tenants who weren't going to potentially not pay any of their rent. And you just said, no, it's the wrong part of the cycle. It's going to go up. The market's going to go up. And you were bang on. You've been calling for a rise in the stock market, and you've been very consistent with 2026 being the cycle point as to which all the signs that you were just talking about now come together. And obviously I think amateurs look for absolute precision, and professionals understand that there is some element of guidance by the difference between what may be an 18 or a 20-year cycle. So things can extend, they can contract. So it's important to look, as you were saying, for the signs, and those signs are starting to come in. One of them being Trump, which I think we're going to get onto. But in between that time, you wrote the book, The Secret Wealth Advantage, which in detail outlines every phase of the cycle and what to do, which is an amazing handbook for anybody who's interested in the markets, no matter what you're trading and what your background is. Your interest in cycles came from some very interesting personal experience with what happened during the 2007 crisis. Do you want to tell us a bit about that?
Yeah, and sorry for assuming that people would have, or be familiar with the overall kind of thesis. And I'm happy to kind of do an overview. But yeah, I mean, my family's business is in pharmaceuticals, and I thought in 2007, as a lot of us did, that these were pretty good times for the business, and there's a lot of opportunities for us to make investments and so on, and we did so. We're in pharmaceuticals wholesaling, that is. So we supply independent pharmacies with medicines and other things. The reality was that it was kind of the worst point in the cycle to be making really major investment decisions. Because 2008 we saw a major banking crisis, and one of the things that banks do in that sort of period is withdraw lines of credit from small businesses, and they unfortunately rely on this for working capital and other things. And if that's taken away, it's potentially very terminal for the business. Luckily for us, it wasn't quite that bad, but we were forced into a merger with another company, which turned out to be frankly, a bit of a disaster. And it's, taken the best part of 15 years to sort out. And I thought to myself at the time, I mean, it's really unbelievable that I was sitting in the office of my father and my uncle's company in 2007 talking about a major investment and thinking that was a really good idea. I mean, I knew nothing about cycles at the time. And then sort of 12 months later, it turned out to be, one of the worst decisions that we'd ever made, and could have been really bad. I mean, well, it was really bad, but it could have been even worse. And I thought, well, it can't possibly be the case that we were unprepared. We didn't have any clue from reading the newspapers. And it was around this time that I started becoming interested in economic cycles and how the world works and so on. And I'd not read anything to prepare me. And I said to myself, well, the world is so obviously kind of going through, various repeating phenomena. I remember the early 90s recession quite clearly because I was a teenager, and I sort of suddenly became aware of the wider world, and we had a recession, and it was a fairly unsettling time for my family then as well. And I thought, well, these things happen periodically. There must be a way to be prepared so you don't make these really bad decisions at the peak of the cycle, and I want to be ready for the next one. And so that led me on a search for, what was going on. I felt I had to look at sort of alternative sources because I wasn't getting any real insights from all the commentary that came out after the financial crisis. And that led me on to discovering, I'd read this book at school called Progress and Poverty by a 19th century American economist by the name of Henry George. And when I was searching for answers, I found that some people had taken Henry George's original thesis and extended it and applied it to kind of modern day. And I sort of started looking at their work. So people like Fred Harrison and Mason Gaffney, his late Mason Gaffney, professor in Southern California, and Fred Foldvari, and who now my business partner, Phil Anderson, who had documented how the cycle works. And kind of shown through their study of history that it happens in sort of broadly 18-year segments, but surprisingly little variation on that 18-year kind of phasing. And the reason why the Henry George connection was so important was Henry George himself in the 19th century had asked, why do we get cycles of boom and bust in these amazingly progressive Western economies? Progressive, I mean, rapidly developing. And he sort of put it down to what was going on in the land market, i.e. that over time you get very concentrated ownership of the best locations. And by land, I mean not just sort of physical land, but kind of natural resources, anything that's freely provided by nature or indeed provided by the community, i.e. sort of public value, which ends up sort of being held privately. And that kind of squeezes, how much people who don't own those assets can make from business activity. And eventually it all comes kind of crashing down after a period of about 18 years. Anyway, so that was sort of led me on to sort of try to develop some practical information on how to sort of see the cycle, how to follow it, and what to do about it. And then ultimately led me to both working with Phil to set up our sort of a newsletter business, Property Share Market Economics, and also writing my book, The Secret Wealth Advantage, which tries to give practical guidance on how to navigate the kind of phases of the cycle.
Now, didn't you release that book in a cycle, an interesting cycle of when Henry George had released his book?
Well, sort of quite, I mean, in some ways quite coincidentally, because it took me so long to write the damn thing. It was released, or I signed it off, I think, almost exactly 144 years after Henry George published his work, Progress and Poverty, in 1879. So I published mine in the middle of 2023. But I signed it off in March, and I think that he released his book in March of 1879. So it was that was the coincidence.
Was it?
I mean, towards the end, I sort of thought, actually, this is coming up to be a interesting number. And those who study cycles see the more esoteric cycles, which you may have touched on with Phil in his interview. 144 is quite an interesting number.
It's in the Bible.
Yeah, it's in the Bible. It's yeah, I mean, you get quite a strong 12-year cycle in various things, and 12-year cycles is 144 years.
Interesting. Tim and I were talking offline about the gold market, and I think this is really important kind of short-term information that's come out. Tim, do you want to tell us about what's happening with gold?
I don't claim to understand the precise logistical things, but there does seem to be a run on gold in London at the moment.
Really, everyone's sort of shipping it off to New York and
exactly. That seems to be the sort of the thread, that it's going from London to New York, and as a result, the London market, you'd previously expect physical to settle within a few days, and it's now apparently taking 4 to 6 weeks, which doesn't sound right.
Yeah, I sort of saw that was it in the FT last night or something?
Well, it was the FT front page headline this morning.
Okay, interesting. Is that? I mean, the FT's take on it was due to traders wanting some kind of hedge against potential
tariffs.
Yeah.
That may or may not be a cover story.
Yeah. Well,
by the way, the direction of travel has been quite clear for the last 20 years, so it's not a new phenomenon, but it just makes us adds an extra frisson to those of us that, for example, own quite a lot of both the physical and also the mining sector.
Yeah. Well, look, I mean, so I started writing for South Bank Investment Research back in 2017, and you were already a well-established figure in that fold, Tim. And I got a lot of questions about gold because a lot of the readers were quite interested in gold, and I think South Bank made quite a lot of money out of selling publications about the end of Britain and so on, and sort of sell.
They were a little early on that call, but they proved right in the
end. And so I got a lot of questions because, how does the cycle relate to gold? And so my view about the cycle, I think I've been sort of fairly consistent in saying this. So my view about gold in relation to cycle is it tends to behave like most commodities in terms of its pricing for most parts of the cycle until you get towards the end. And you get once you get towards the end, it's potentially seen as an inflation hedge. But I think more importantly, as people start to see signs of problems in the banking sector, the financial system, gold is the natural place to put money. And you particularly see how valuable it is after the peak of the cycle, when you get the crisis, and it sort of just goes to the moon. Whether there'll be a variation with this cycle, and some of what ended up in gold might end up in things like Bitcoin, remains to be seen. It's a possibility, but certainly I feel we're seeing a lot of the signs that you might expect as we get towards the peak. I think if it's true that it's a hedge against sort of financial turbulence, I think this is just the beginning.
I mean, to quote J.P. Morgan, the banker, as opposed to the bank, gold is money and everything else is credit.
Yeah. Mm-hmm.
So it feels to me and to us as a business that we're closer to the end of, let's say, the current monetary system than we are to the beginning of it. So interesting times.
Very interesting times. Yeah, I mean, I think so. I get a lot of questions about the end of the dollar and other things. I tend to think that these things take place over years and decades rather than kind of weeks and months. But clearly, and reflecting the sort of more multipolar world that we're moving into, I suspect we'll have a currency system that's based upon a portfolio of currencies or commodities, rather than something that's underpinned by one currency, which gives the producer of that currency kind of unrivaled power and say over the affairs of other nations. So I think that probably that boat started moving in the direction of diversification and so on probably quite some time ago, but it started to become really apparent after things like the start of the war in Ukraine, and other things. And I was reading somewhere that the first few years of that kind of process would actually strengthen the dollar or something. I can't remember what the reasoning for that, but so people have talked about the strong dollar in the run up to the problems in the gilts market in 2022, and dollar having another surge over the last sort of few months. But I don't think that's, from a technical point of view, and Paul, you'll like this, it's these peaks are lower than previous peaks when the dollar had a big run. So actually, that, to me, that's signaling the long-term outlook for the dollar isn't particularly good.
Yeah, I've been watching the individual currencies against the dollar, and the Canadian dollar was actually very weak, and it kind of led the dollar move up, and the US dollar move up. So it was moving ahead of everything else, and it stalled, and it's been stalling since we've had strong data, we've had talk of less rate cuts and all that stuff, and it just hasn't gone any higher. So to me, that looks very much like we got some saturation, and the dollar index hit a high at 108.9 or something, close to there anyway, and it was a really interesting level, and it's come straight off it, and it's starting to move down. We've just had no change as expected from the Fed yesterday, and we're probably going to get another cut if you look at the futures market. So all this talk of underpinning the dollar looks like it's coming off. It looks like it's fragmenting anyway, but that kind of fits into your long-term expectation of where the dollar should go in this point in the cycle. So it's interesting how things seem to arrange themselves to kind of make it work, which is
make my predictions work. Yeah,
exactly.
Just how I like it.
Well, you're just controlling the market, and
absolutely.
Well, God moves in mysterious ways.
Indeed. No, look, I mean, I have been surprised by the strength of the dollar. I mean, if I'm totally honest, I thought the peak of the dollar would be around them. So, I mean, actually, maybe I'll just quickly do a slight tangent, just to say that for those of you unfamiliar with the 18-year cycle, you get sort of 14 years up, 4 years down, and that 14 years up is sort of roughly two 7-year halves interrupted by a mid-cycle slowdown, and the 4-year at the end is the real crisis, and the banking system collapses and the property market crashes and the stock market crashes. It takes several years to sort out before you start the next cycle again. So having said all that, the last cycle, the dollar peaked in 2001, which was at the mid-cycle. And then it was down, all the way for about 7 years, all the way into 2008. And then when you had the main crisis, then everyone wanted dollars again. And so I was expecting something like that. So I thought you might see the sort of peaking of the dollar in 2020, thereabouts. That's the mid-cycle for this cycle. But we had this sort of surge in 2022. And And then I thought, okay, well, that's, it's maybe come slightly later, but that's the sort of, had the real panic in October of that year. And I thought, okay, that's the peak for the dollar for this cycle, and it will go down. And actually, it will be given, if you looked at the time at a chart of the US dollar, the DXY, it looked like actually that wasn't a particularly bullish outlook for the dollar because it was a lower high. And so you would expect the dollar to come down even harder, so to a lower low against other currencies than it reached in the run up to 2008. That sort of started to work, and then we had another surge in the dollar over the last sort of, 12 or 14 months. And that was, I think, a bit unexpected. It almost feels a little bit like the 1980s, which was quite a turbulent decade for the US. And we think of it as a sort of big 80s bull market, but it started off in quite a bad position, and it had, interest rates up at very high levels and all that sort of thing. And there was a lot of things going on and a lot of geopolitical turbulence. Of course,
imagine a world where central banks can actually raise interest rates. Isn't that stunning?
Indeed. Well, yeah, really raise interest rates. I think that, it almost feels a bit more like that decade. And so in that decade, we had a slightly shorter time when the dollar fell, but that was somewhat engineered. Because the dollar was really strong against all the currencies, and that affected sort of trade deficits and other things, and so on. And they wanted to change things, and they forced the other, at the time, G5 countries to help weaken the dollar. I don't know if Trump, who has said in the past when he was president the first time, he wants a weaker dollar. So I don't know if that might be where what turns the dollar around. People are anticipating something like that. But also, I think we should bear in mind that this cycle there are some variations, and one of them is that the US is, the world's largest energy producer, and while a lot of it stayed within the US until the outbreak of the Ukraine war, also becoming a very large energy exporter, of course, pushes up demand for dollars. From a new source rather than just settling trade and so on. So there are maybe some variations. Nonetheless, as you say, I think maybe we have potentially seen the peak in the dollar, and if it goes down and it has a bit of a run down, I think it may end up being quite bad in when you get to the end of the cycle, when some of the chickens come home to the roost in relation to the US fiscal position and policies and other things, which I think are not. I think it's. The thing you'd say about this point of the cycle is that while asset prices are very high and people who own assets are, all in profit, and you get some a feeling that it's a new era. It could be, the end of a war, or it might be some major policy change, or indeed it could be a change in administration. I think you certainly get a sense coming out of the US that, it's things are very different now, and all the attention is being paid to what's going on and what executive order is being signed today and what that's going to do. And I think what you really kind of need to see is that actually, despite all of the sort of feeling that's a new era, despite the fact that the stock market is at all-time highs, actually from an economic point of view, economies are at their weakest at this phase in the cycle because land prices are very high, people are being squeezed. It's very difficult to kind of pay for things. A lot of people who are living at the margins of society are basically living hand to mouth, or they're doing so on borrowed money, and so on. So credit card debt goes up and so on, and it sort of comes to a head at some point 18 years after the previous cycle.
How big a deal do you think the DeepSeek AI news is?
Could
it be the pin that pierces the sort of the AI big tech bubble?
Well, potentially. I'm not yet sort of. I think I need another couple of weeks to see how it plays out. I mean, it does potentially change the sort of the mood and the mentality that US tech dominance is not a given. I think it would be a bit early to see the real peak. So it might change the mood and the mentality. But actually, funnily enough, one of the predictions that I've made, which actually hasn't turned out correctly, is that you see that the industrial non-tech stocks do better in relative terms in the second half of the cycle compared to the tech ones. And the reason that I think that's an incorrect call, at least on the face of it. What I'm putting that down to is that actually the reason for that is because industrial stocks and other things are companies that are making the major investments and growing the fastest. And actually in this cycle, because of the nature of technology being all pervasive, actually the most of the capital investment is being done by the tech companies in buying and building data centers and buying chips and so on. But all of which to say is that maybe this brings about that sort of prediction that actually it's not going to be so much tech focused over the next couple of years. I don't know how much is hype and how much is reality. I think that we just need to wait and see. But it's potential. I mean, it's definitely something to watch out for.
Paul, what's your technical read on Nvidia stock, for example?
On the NASDAQ itself, it still looks like it's going up. I mean, it recovered very quickly given the headlines, which I thought was quite an interesting result, that this big sort of announcement was supposed to have shaken the US and it actually didn't do anything at all. I think moreover, it just looked like the Chinese market might go up a little bit and there was more focus in that direction. But I'm just going to get a chart up on Nvidia. It's come off. It's come off, but it could still be a normal market correction. I mean, I think short term it does look like a bit of a sell, and especially given that there has been so much hype around it. I think if you look at the chart of the Dow Jones Transportation Index, which virtually nobody's looking at, it looks like a fantastic chart. It looks like it's going to break out, and the Russell 2000 actually looks really interesting, the small caps. So I think what you're saying there, Akhil, actually does look like it's going to come to fruition. And this could, as Tim say, be the pin that kind of bursts a bit of the allure of these AI stocks. I also see a lot more comments about people saying it's very hard to monetize AI. And that could be the case. There's so many businesses that have just suddenly set up that will create pictures and make short videos and do things that are kind of interesting, but not really. I don't know if you can really sell it. And I remember
if you can get good stuff for free, why would you pay for it?
Well, this is also the problem. A lot of it is open source. So what are you trying to sell? What are you trying to get people to buy from you? I think I've always thought the efficiencies, and I'll be interested in your views on this, would come to smaller companies at some point, like trickle-down technology from Formula One goes into the car that the man on the street or the woman on the street buys. And I thought the same thing would happen. Clearly the tech companies have had AI using it for analysis of what we say and what we do, and using it for their large language models. But now we've all got access to it, so we can create our own chatbots and analyze our own data. So again, it's not that it's not game changing. It is really fantastic, but it's also, you still need to make money out of it.
Yeah, I mean, I'd sort of heard on a podcast somewhere from someone who's, I think, fairly senior executive at a tech company or a platform company or something, that the companies that own these large language models can't effectively monetize that. I mean, ChatGPT can charge you £20 a month or whatever it is for their premium product, but the cost of updating these models is so vast that actually, even if you got 100 million paying you £20 a month, you're not actually going to make a huge amount of money, certainly not to justify the valuations of your companies. I think where the real money is to be made is when people work out what the serious applications are for applying these technologies to business processes and being confident that they're not going to throw up some things that are just incorrect or whatever, or somehow not going to break. And I think that will take a bit of time. And the analogy that I draw is with the railway boom in the 1840s. And I appreciate that it sounds very, very kind of left field sort of comparison, but I used it to illustrate the land boom phase of the cycle in my book. And the reason I chose it, in addition to it being kind of described by The Economist as the largest boom in history, or the largest mania in history, partly because of the amount of investment relative to the UK's then GDP, like 7 or 8% or something. It was an enormous amount of money going into railways. Was the first kind of phase of it into the stock market boom from about 1841 to 1845. The stock market doubled or went up by 2.5 times. It was all these sort of railway companies purporting to be investing in railways. Some was fraudulent, but some was actually genuine investment, but it was done in a very inefficient way. You had sort of parallel lines, and there was basically no way of really making money except on paper when people had very inflated views of how much demand there would be for their service. And I feel that with some of the AI investment, you're going to get a bit of that going on. It's a huge amount of investment. You have to be seen to be doing something AI related because it is an absolute game changer in terms of technology. But the initial phase is a lot of hype. And actually, I think a lot of companies aren't going to make very much money out of it. And I think maybe this news out of China is the first sign of that. Actually, I mean, there's all this discussion about whether they've somehow managed to steal some technology from OpenAI or whatever. I mean, you're obviously going to get that kind of discussion. I mean, I'm not surprised that the Chinese have found a cheaper way of doing things without access to the sort of technology that the US is denying them, because that's basically what competitive economies do. And so whether or not there's some fraudulent activity on the margins, I don't know. But the reality is someone is going to discover a cheaper way of doing things, and then you don't have to invest quite so heavily in this really sort of top end gear. But the real key thing is to find the applications that make the economy much more efficient. And I think that will take some time. And a lot of the hype now will lead to sort of fairly significant kind of problems for those stocks in the next sort of couple of years. So I suppose on reflection, yes, I do agree that this is probably the point at which the warning signs are starting to be seen. But that's not to say that you couldn't have a very significant year and a half of things going up as the hype kind of returns.
It also suggests that sanctions are a complete waste of time, and that political reality is yet to set in amongst people who are levying them.
Yeah, absolutely. I mean, I think sanctions is a ridiculous tool anyway, but we've had a lot of examples of sanctions in the oil markets and semiconductor chips and so on. I mean, Nvidia's, all these companies, they want to sell chips to China. I mean, this is where all the major investment is happening. I mean, it's, on purchasing power parity terms, it's very comfortably the world's largest economy. And it has, it's a very tech heavy economy as well. It maybe not quite so much as the US proportionately, but is still very, very tech heavy. Of course, you'd want to be selling that, and you'd probably be finding ways of doing that. So in addition to the fact that probably they were getting hold of these high-end chips anyway, or it was coming via different countries, et cetera, they found a cheaper way of doing things. And the oil market, you couldn't sell Russian oil into Europe and to the US or wherever. So they were selling it to India, and it was being refined there and then being sold into other parts of the world. So it was just, it was total nonsense.
With regard to the tariffs, do you think, just to circle back to the dollar, because we didn't really talk much about the tariffs or at all, what do you think that could be a factor in why the dollar rallied? And do you think the tariffs will be watered down or will not be? Do you think it will back away from it? Because it seems to me, having listened to Elon Musk talking on the Joe Rogan podcast about what you need to do in order to create a successful car company. It's not about the car technology. It's all about the manufacturing and the process of bringing everything together. I just think knowing that if you start a tariff war, you could seriously upset a lot of those processes. And that would be a huge risk. I mean, he's talking very bullish on it, but I don't know whether it's all hot air. What do you think?
Well, I think he's. I don't know if it's hot air or not. I mean, I think he probably believes that tariffs are a good idea. I think in the first administration he did impose tariffs on China, and he might argue that he did well out of it. I'm not sure that actually was the case. I think he got the Chinese to buy soybeans or whatever it is, US agricultural products, and it sort of reduced the deficit for a time. But, we're still dependent on Chinese manufacturing for virtually everything else. I think, but anyway, it's seemingly seemed to work. I don't think it's necessarily going to work this time in quite the same way, particularly if you're not only threatening China, with whom you can have a bilateral discussion, and behind the scenes, I'm sure the Chinese are, I think, quite smart, and they probably worked out a way to both sides could kind of save face and get sort of a deal done. If you're doing it across the board with everyone, I think it becomes very complicated. I don't think you can foresee all the effects. And as you say, all of these long supply chains, which the US is, wanting to become a manufacturing powerhouse again, is dependent upon. I think it will backfire spectacularly. And actually, the US dollar rallying in that regard, I mean, I don't know. I'm not really sure why it's doing that. I don't think anyone does really. But one of the ways in which it might be having an effect is that people expect that tariffs will ultimately kind of cause inflation to go up, because we're talking about a less efficient economic system. And if that's the case, the Federal Reserve will be under pressure not to lower rates. Will be under pressure to lower rates because Trump has said he wants lower rates, but also, in terms of the data and so on, will be under pressure not to do that. And so at the time when other economies in a much more precarious economic situation are lowering rates, the US not doing so pushes the dollar up. So that might be something. I don't know. See how it plays out. I think, maybe he hopes that he will threaten tariffs, people will adjust and do what he wants, or some of what he wants, and he won't have to go through on his threat. Maybe that's the tactic. I suspect that the world trade patterns of world trade will shift, and that isn't necessarily good for the US economy.
Do you think that the Trump meme coin and the Melania meme coin are signs that link to the end of the cycle?
I mean, that that was, what a story that was, huh? Wasn't it? I mean, he was at an event with all these tech people, tech billionaires, and that's when he launched it. Is that right? Well, over the weekend, it went up in value by $60 billion, and then Melania introduced hers, and it came down in value by 20 billion or something.
Well, as a value investor, I feel obligated to point out that there is also Fart Coin, which is quite cheap. It's only $2 billion in market cap.
Bargain.
I mean, it's incredible. I don't know what the hell that's all about. I mean, I think the reality is, and I know that previous guests on your podcast and what I've seen, and I think people genuinely feel that it's a different kind of approach to politics and so on. There's all these changes coming, and it's on the whole very good, and so on. For me, this guy is a real estate guy, plus a sort of a reality TV star. He was burned by the real estate cycle in the late 80s, and he was burned in the 2000s. And I feel he's going to be burned again. So this is 3 cycles in a row. He likes to make money. He likes to have his name on things. He likes to be the center of attention. I feel this is just history repeating, but he's now, in control of the nuclear football. So things aren't, from my mind, particularly positive in that regard. But he is very good at using his fame and his notoriety to build his brand and to monetize it. I mean, he's spectacularly good at that. And I see things like these coins as an example of him, using his fame and his connections in the tech community to make money. I don't see it as any more complicated than that. I've seen some analysis saying, well, it gives him the opportunity to not to be beholden to the government to fund his, various things. His transition was funded out of, by, his donors, or it was funded by, something else. And so Congress couldn't see what he was up to, because usually Congress would authorize, funding for a transition team. But, the point is, though, that the US system is based upon congressional oversight and checks and balances and so on. And you don't actually want any of these things to be happening, regardless of, what you believe about the US government and the size of it and so on, and what you think about Trump. I think to me, it's particularly kind of worrying that it's happening at this point of the cycle. But actually, from my point of view, it's quite good, because he will do things which I think will really kind of make the cycle repeat, and so it'll make me look quite clever in a few years' time. So I'm quite grateful to him for that.
Well, you could make the same point about executive orders, which is a very imperial way of running a business, running a country. Freudian slip, nearly said business, but running a country. Yeah.
I think my understanding of how he ran his organization, he likes to have an inner circle, and it's a bit like a court, and he has trusted advisors, and they have to show loyalty to him, and so on. I think he and that's just his way of doing things, and I think it actually fits quite well with being US president. You have your sort of Praetorian Guard, you have your Secret Service, and you have your circle of advisors, and you can appoint who you want to the top positions in the government. And he's clearly wanting his own people. Now, there's nothing, in some ways, nothing inherently wrong with that. Every time a football team changes their coach, they do the same thing. They bring in their own people to the most important, parts of the business. I think the problem is that the world is very complicated, and you actually want people telling you stuff that you don't necessarily want to hear. And you particularly want to have that at this point in the cycle, or what we're coming to. And I kind of expect that actually he won't get any of that, because he's not really interested. He's got his own people. They're with him. Some of them are with him because they're ultra loyal people, and they really believe in the cause, whatever that is. So other people, I feel, are there because they're using him for their own ends, but none of them have any interest in sort of upsetting him or telling him stuff that he doesn't want to hear. And I don't think that's particularly positive from a point of view of making policy and governing.
Elon Musk tweeted that the national debt is a problem and will cause inflation, and you corrected him on it. What were you trying to teach him?
Yeah, I'm not sure he paid any attention to my post. If he did, he didn't give any hint. No, I mean, I said
we have a back channel by Dominic Frisby, though, so we can do that.
We can hook you up.
Okay, right. Again, I'm not sure Elon would necessarily want to hear what I have to say. No, I mean, it's this thing that I've always said. I think I've said it in previous appearances on the show. I've said it in my book and elsewhere. For me, the issue is not money printing per se, because in fact, all money that we use is printed anyway. It's either printed by a bank or it's printed by the government. And you have vast swathes of the economic cycle where none of that is inflationary. It's not the printing per se, it's what you do with it. And so if you are printing money, a bank prints money when it lends money. If you're printing money to lend to a business that increases its production, it's inherently non-inflationary. It's increasing the productive capacity of the economy, and money is being used wisely, and so on. Now, it is theoretically possible. You might disagree whether it's practically possible. It's theoretically possible for the government to do the same thing, and if it does so wisely and it makes investments in roads and ports and airports and other things, which, where there's demand and so on,
windmills.
If it's going to make things more efficient, then that's not going to be inflationary. So the point is not, and then it chooses how much of what's in the economy to take back in tax. And if you take back all of it, you're basically draining the economy of excess money. But you don't need to do the whole thing. You can in fact, the other way to look at the deficit is a measure of savings in the economy. So my point was that Elon Musk saying that you tax and then the government spends and it's spending more than it taxes and it's creating a deficit is the wrong way around to look at things. And that was all I was trying to point out. I mean, of course, this guy has been tasked with reducing government spending by 2 trillion or something by the 4th of July, 1776, 2026, the 250th anniversary of the Declaration of Independence. I mean, absent some other major investment to get the US economy really sort of booming, it's going to create a rather large hole in the US economy. And I don't think that's necessarily very positive unless they've got a very bright idea as to what fills that kind of gap. So, and in any case, I'm sure he's not going to get anywhere near that because most of what the US spends money on, the US government, is defense and the entitlement programs, which are very hard to change. I don't think even Trump is going to go after those, not least because a lot of his supporters are dependent on those. And then, interest payments to bondholders. And there's not a huge amount of discretionary spending. And I don't think the 2 trillion is going to be quite so easy to find unless of course, you somehow persuade the chairman of the Federal Reserve to put interest rates back down to zero or something.
So in that context then, because the point I tried to make about dealing with a debt burden is the 3 ways. 1 is grow the economy, 2 is default, and 3 is inflate. Which would you vote as the most likely outcome?
Well, look, it's definitely possible that the US economy is growing pretty well, and it's possible that with well thought through tax cuts and deregulation. Not total deregulation, and reducing the size of the state and supporting the private enterprise. It's possible that you get growth to go higher than it is already. But I'm not sure we're really. I'm not seeing yet signs of that being a possibility. So the other option is inflation. I do think the bond market is suggesting that inflation is returning.
Because we're also getting a really potential for a really nasty flare up between the Fed and Trump. Because Trump's not one to back down, and the Fed has to at least optically preserve its sort of sense of independence.
Yeah, so I think it's really hoping that the data will start to come in a bit cold, so he can actually do what he wants, because the data is pretty strong, so yeah, I don't know. I mean, it remains to be seen. I think they're wanting to reduce interest rates. I think my view of all of that is interest rates were. I don't think interest rates affect inflation in quite this way that central banks think they do. I think they have this. They feel they have these levers and they can pull them, and the economy kind of dances to their tune. I don't think it's anything like that. I think inflation was probably coming down anyway, and the interest rates being up at sort of 5 or 6% for an extended time, I think it's been made it very difficult for a lot of people, homeowners and businesses and other things. And I think they really would like to find ways to bring interest rates down, but in a way that preserves their credibility. If data is showing things are going quite hot, then they'll struggle to that. Or they might worry that actually it's returning. And I actually feel that we're now starting to see signs that it's returning, which will put them in a difficult situation. They have the dilemma of needing to reduce rates politically and also reduce rates because some parts of the economy are struggling, but not wanting inflation to return and feeling they have to raise rates to keep inflation under control, even though it probably doesn't kind of quite work in that way.
What do you think the property market will do in the UK this year and in the US?
I mean, the problem with talking about the property market is, you're talking about several different markets and so on. I mean, overall, I think in both countries, prices are going up. It's when we did a piece of analysis about 2 years ago at Property Share Market Economics, and we sort of looked at the effect of, we looked at what happened to house prices in the US during every rate hiking cycle since the Second World War. And we found in 10 out of 11 of those periods, house prices rose. And in the 11th one, which was in a recession or something, not in a recession, sorry, it was just after, it was in the early 80s or something, house prices went down by 0.5% or something. So I think even though interest rates are high, I feel that we'll have a continuation of prices rising. The only period where we didn't get prices rising since they started raising rates was, I think, the second half of 2022 and maybe the first quarter of 2023. I don't think they're going to go up by much. I mean, it is really quite difficult to get on the housing ladder if you're a new buyer, despite all the sort of products to help you, 90% mortgages and, other things, in other countries, home buyer grants and other things. So it won't be a sort of a massive kind of 20-30% increase in house prices like we saw in 2020 or in 2013. So yeah, but that's the overall picture. Obviously, in some markets, some areas where there's quite a lot of supply, prices aren't going to rise. Where there's not much going on, prices aren't going to rise. So that's kind of an overall picture. The UK, I think, sentiment is really quite negative at the moment. So even if prices aren't falling, it's not like buyers are kind of out in their huge numbers buying things. So I don't think things are going to go up very much. Having said that, I'm getting calls from my local estate agency asking me if I'm interested in selling because there's a lot of attention on my road and so on. So it kind of really depends.
Yeah, obviously it's regionally affected. So a blanket, will it go up, is never going to be the answer. It will always vary depending on where you are. But I noticed that some of the house builders were either in consolidations or corrections. Didn't look quite as bullish as the American ones, which sort of have been on a
they
tear.
haven't for quite some time. You see, you're talking about sort of Taylor Wimpey and sort of Barrett and I don't know if they're still listed. Yeah. No, I mean, the US ones have been pretty strong, but they've come off over the last sort of 4 months. And so just for those who are listening and might not be familiar with the sort of idea, I set it out in my book that one of the warning signs of a peak is house building stocks not doing as well as the broader market. And the reason is they're pricing in more difficulties in the property market and therefore more difficulties in selling. And therefore, that's a sign that the land market is potentially turning over. I think in the US, we need to see the next peak and where that ends up. So we've had a correction, quite in some cases, quite a significant correction, but it's not to say that the stock prices might not reach a new high. I think we'll know this year whether that's the case. We'll just have to see where the next high comes in. But that will be quite a good sign. In the UK, I think since 2022, after interest rates started going up, it's been a real struggle for house builders. I think for a couple of reasons. One is they probably don't have access to any cheap land. and people can't really afford to buy the product at the prices that they're putting them out at. And of course, in addition to that, their costs have gone up, so their margins have really been squeezed, and their costs have gone up for various inflation, war-related reasons. Quite the cost of materials have gone up, but also labour shortages and so on, for a number of different reasons over the last few years. So their sort of performance, I mean, they peaked quite some time ago. I think what we need to see is whether this consolidation is going to lead to some further upside and then a fall, or it's just going to go sideways and then start falling. It's a bit of a mixed bag, but I think not as much building is going on in the UK as you would expect for various reasons. High house prices, high costs, low margins, high land prices. So I don't think many developers can actually make any money. So, but that's not pushing prices down as yet, because one of the problems with the UK market is rents are absolutely ludicrous levels, but people have no choice, because if you can't afford to buy, you've got to rent something. But rents being high is, I think, putting a floor under house prices for the time being.
Lloyds Bank is pretty much, the way I see it, it's a call option on the UK property market that has been moving up recently, and the banks have been doing pretty well. They're in generally an upward trend, some very strong.
Yeah, some quite strong.
So I wonder whether that's a leading indicator. I mean, Lloyds as of today is trading at 62p, and it's very close to its a high going back to 2020. There's a lot of resistance up at 73p. So if it started trading close to those levels, it would look like something is going on. Perhaps we'll see a change in the house builders for a move up, but I guess we just have to wait and see.
Yeah, I mean, what I said about house builders may be a reason to sort of be wary about using it as an indicator, as I did in the previous, or when I analysed in the previous cycle. They may not be building much and may not be earning much from what they're doing, which would explain why their share prices are sort of fairly weak. But people are still buying houses, existing houses and so on, and having to borrow more money and having to pay fairly high levels of interest. And so banks, I think, are doing quite well on the back of that sort of business. And also they've spent the last sort of 10 or 15 years finding ways to cut costs. And so margins are probably up and they're being reflected in better share price.
Yeah, that makes perfect sense. Of course, the banks would make the money, and they're slightly struggling, but there's still some good business to be had.
Yeah.
Tim, I just realised we've gone. I can't believe we've already hit an hour. Do you have a cut-off point, or how long?
Keep going. It's fine.
Yeah. Okay. So I was thinking about how in Elliott wave theory the markets are fractally based, and I wondered what do you think the shortest term cycle that there is? Because obviously you're looking at lots of different cycles, the 18.6 of course, and you mentioned the presidential cycle, I think, when you were last on the 4-year. What is, do you think could you go into like daily and hourly cycles as well? Is that something that could be explored?
Yeah, I don't, but I'm told there are. So you have sort of four. I mean, the principal cycles that I look at are sort of 4 years, 10 years, 20, 30, 60, in addition to the 18.6 year cycle, which is the main one, it's the property cycle, and related to the 60-year cycle. And so 30 and 60 years come up very strongly in commodities and in the stock markets. In addition to that, you could argue that the long cycle, which is the otherwise known as the Kondratiev wave, is that, or it's a slightly different cycle, roughly 55 years. So my understanding, because I don't study very short-term cycles, but my understanding is all of those sort of 60 and 30-year cycles can be seen in 30-week, 30-day, and 30-minute kind of cycles. So you can break them down to really minute fractions of time. if you're inclined to do so. Unfortunately, I don't go down that route. It's too much work, basically.
Right.
But if I were a trader or a day trader, I certainly would be delving into that kind of stuff because it strikes me as being quite important. Now, why they occur, I mean, it's not something we've really touched on in kind of previous interviews, but there are a lot of people. You start studying cycles, you can't go very far before you bump up against someone who's saying, well, it's all related to various sort of planetary movements and so on. And I think, we can all kind of accept in some senses that must be true because, we see the kind of monthly 30-day, 28-day cycle with the moon phases and so on. And it brings repeating natural phenomena. And it also, in some senses, brings repeating human behavior, as hard as that might be to believe. But I think the Bank of Scotland in 2006 did a study about kind of moon cycles, and they sort of pointed out, using data going back to 1927 or something, that if you had bought on the new moon, bought the index on the new moon and sold on the full moon, compared to just holding all the time, or compared to buying on the full moon and selling on the new moon, you would make very, very different returns. In fact, buying on the new moon and selling on the full moon outperformed the index by very significant magnitude over time. And if you're a gardener, I think you would know that planting on the new moon is better for things. You're in the kind of growth phase of the lunar cycle and so on. So there's something there. I don't purport to understand it very well. I think I have looked into it in some detail. And I think if you were to look at really short-term cycles, you might see these things in some detail. I don't know what would be causing it or be correlated to it. Probably a more accurate way of saying it. But I'm sure there's something that you could point to if you looked into it in detail.
I thought it was absolutely fascinating that Graham Hancock, in his series of The Ancient Apocalypse Season 2, which was going to be my media pick, was looking at the Mayans and how they were tracking the 18.6 year lunar cycle, the 9-year the 9-month cycle of Venus, and were looking at cycles of many thousands of years supposedly for a civilization that had a very short lifespan. Why would they go to so much trouble, given how harsh the land would be and how difficult it would be to live, to actually do all these things? And what was it about it? I mean, as you say, for planting, it must have been important. It must have shown some type of prediction. And it just shows that there's so much that we just really don't understand, and things that we in this modern world just dismiss as the ancients or things that we think are esoteric and like reading tea leaves. Actually, there is some form of repeat that they were obviously seeing. They thought it was valid to expend a lot of energy and I mean a lot of energy in mapping these cycles. So, although we can't explain it, like a lot of things, there's a lot of things we can't explain, but we know exist. We don't know why it exists, but we know it exists and we're affected by. In the end, I guess it's if the markets and nature responds to it, then that's kind of good enough. Oh, is your battery gone? Or was that a mic drop moment?
Oh no, sorry. I somehow muted myself.
It was worthy of a mic drop moment.
My first in however many years.
Yeah. I was going to say that, whatever it takes to make money is what you should do. And if there are repeating cycles and you don't want to know why they exist, well, it doesn't matter. You just sort of, you look at your history and see if indeed that is the case, and if you can exploit that knowledge to invest in a better way. But just back to your point, I mean, look, these ancient civilizations in some ways were incredibly advanced. To build the monuments that they did with the technology that we think they have at the time, I mean, it's just incredible feats of human ingenuity and
possibly superhuman.
Quite possibly. And, there's all these sorts of things about, whether there was some alien technology or there's some technology that they had which we don't have or whatever. I'm totally open to some of those things. But nonetheless, they weren't probably wealthy societies in the way that we think of it potentially. And yet, whatever they did have, they expended on these enormous sort of monuments, most of which kind of track these long-term cycles. Stonehenge is another example. It's calibrated to probably all sorts of cycles, but one of them is the 18.6-year lunar cycle. I think they knew that the natural world runs to that. They were, agrarian economies, and probably largely a lot of them, and they, it was no joke. You needed to know. You needed to know how these things worked, because if you don't have a good crop on a particular year and you haven't stored any surplus from the previous year, it would be pretty fatal for some societies. So they needed to know these things. They were much closer to nature than we are, living in cities and kind of dominating nature in the way that we do. And so maybe we can get away with it, but it doesn't mean to say that these things don't exist. And the interesting thing is that they certain things find their way into, emotional activities like kind of financial markets and investing and trading, even, despite the fact that we think we're very sophisticated and, these things don't affect us. I think that's the really interesting thing. I remember reading an article in some local paper, probably about 10 or 20 years ago, about how whenever there's whenever the full moon is on a Friday night or coincides with a football match, the police force of that location, I don't know where it was, somewhere in Sussex maybe, would have extra officers out and about, because they would see kind of more lunatic behavior, which kind of literally means affected by the moon behavior. And so they prepared for that by having more police officers on the street to kind of keep things calm. So, it does have effects and in a way that can be used practically. I'm sure that if you looked at Starbucks sales data, you might find some quite interesting patterns. People go for more coffee on certain times of the month or parts of the year or something, depending on what's going on with these cycles.
A friend of mine's a flight attendant, and she says that they know when it's a full moon because of the way the passengers start to act in a strange way.
No, really?
Yeah.
Interesting.
Yeah.
Did you say what sort of behavior?
I guess they can just be more cranky, just
right. Interesting.
Yeah. Just I'll ask her and I'll report back. But they would sort of talk to each other and say, check, look, this is really odd. People are acting a bit strange. Is it a full moon? And it would be. So.
Well, the thing, it's not, individually we might think we're sort of very, free will and we do our own thing and so on. But when we get into crowds and we're reacting off each other, you lose some of that. It's quite hard to kind of to stay on your own course when you're in the middle of a crowd and there's a lot of emotion going on. And maybe emotion is, for whatever reason, heightened by certain things like, the full moon. And you kind of behave accordingly, so that you see it you don't see it so much in the individual, but you see it in the crowd, where it's sort of, it's more of a collective kind of energy going on.
Absolutely.
And similarly in financial markets, because we're all reacting off each other based on what the price is doing.
I think obviously we're going to have you back on the show before 2029, but one of the big numbers that's coming up, 1929. When I first started in the markets, I studied the crashes, and I thought the crashes were really interesting.
Yeah.
And you had 1929, you had then 1987, and then we had 2007 as the I always call it 2007. Obviously, it was 2008, but it started to me in 2007. So those were the big crashes, and in between, you have 2001 with the dot-com bust. Given that we are approaching such a big, anniversary, I know it's a few years away, does that amplify the effect of the potential crash that we're now facing, or will it not rhyme like that?
Like to get the 1929 crash, you need to have what happened in 1927 and 1928. You had some really highly speculative couple of years in the markets, and
Trump coin, Melania coin,
well,
coin,
that's a thing on a really sort of grand scale, not not a
Nvidia.
Yeah, no, right, but what the interesting thing about the 1920, so look, what was interesting about that episode was that the land market peaked in 1926. So yes, there is.
Hello. That's an interesting 100 years.
100-year repeats. But then I think, like, my sort of reading of history is that the UK government went back on the gold standard at the old pre-war price, and to facilitate that, the US Federal Reserve cut interest rates. And given where we were in the cycle, right towards the peak, and there being a lot of money, partly because we had the Roaring Twenties, and we had sort of feeling of a new era post First World War and so on, and had all this building and new technology and automobiles and all the rest of it. That kept the cycle going. You could say it that way, or at least the stock market part of the cycle going for an extra couple of years with interest rates at lower levels, and you got this really, really big kind of crazy couple of years, and then it all came crashing down in 1929. I think if we get something similar to that, we get a sequence of events. We get rate cuts, we get tax cuts, we get this sort of real frothy feeling of this is a really different time. And so yes, in addition to Nvidia and the Mag 7, we get sort of a really kind of speculative boom. We have all these coins, and you could argue maybe it's already happened. But I think I feel we'd need to see another year of really crazy stuff, or a couple of years. And it may not.
Donald Trump is the person that can deliver that.
Well, exactly. So there is definitely the possibility of that. But he may sort of precipitate all of that. We may not get there because he creates some massive trade war and people retaliate, and they can't actually, the inflation runs riots, it comes back in a really major way, and we don't get to that point. So I'm saying, well, I guess what I'm trying to say is it's definitely a possibility. It would be, you do get 100-year repeats in markets. If you go back, I mean, this would be an interesting parallel. If you go back one century further, the UK had a major boom into 1825 and then a major crash. And I think actually the crash occurred before the peak. It's probably one of the few episodes where the stock market crashed. I mean, not that it had a really massive stock market at the time, but the stock market crash occurred before the peak of the cycle. So there was a lot of speculation in canal stocks, but the real estate market, such as it was, went on for a bit longer. So, I mean, maybe in those days you had stock market investors and you had property market investors, and the two things were sort of fairly separate. And so you can have these sort of slightly disjointed episodes. But I suppose the point of what I'm making is the 1920s, you do often see, the 20s part of a decade, looking at the 100-year cycle, you often see a major crash. That doesn't necessarily happen to be at the end of the decade. It could be a bit earlier. So both of those potential options are in play for me as we look into the end of the cycle. But I think we just need to see what happens this year and into the start of next year before we can I can make a slightly more confident prediction.
You mentioned I think at the top of the show, you mentioned the tallest building. That's apparently one of the signs that indicate we are nearing the end of the real estate cycle. What are you seeing in that regard?
Oh, we've had a few. I mean, most of the tall buildings these days are all in China and other parts of the world. But you had, the tallest building in the US, in Oklahoma City, of all places, being announced. You've had the tallest building in the city of London, announced. And interestingly, can't quite work this out. It's sort of about 10 feet less than the Shard. I would have thought you would just, if you're going to build that high, you might as well go for the record. But anyway,
stick a pole on it and just go
maybe
higher.
there's some planning restriction. The Shard, like St Paul's, had to be the tallest building in London. Now maybe the Shard has to be. And actually, I think that itself wasn't supposed to be quite so high, but they sort of. They ignored planning permission, or just sort of somehow persuaded someone that they go higher than they'd planned, or they got permission for. Anyway, so you've got that. You've got sort of major, the Kingdom Tower in Jeddah and other places. You've got Neom, that sort of sideways building, effectively, in Saudi Arabia. You've got lots of super talls in China. Dubai just announced a 17-story crypto tower. It's not obviously the world's tallest, but the world's largest building devoted entirely to kind of Web 3.0 and crypto technologies. So there's quite a lot of that going on. And of course, it's an indicator of the peak of the cycle, because it relies on, very easy credit, very bullish outlook in wherever it's going in, and also very high land prices, such that, building up gets you a better return on the site.
So outside of the US, what economies do you think are going to be the most interesting ones post the crash and recovering? Because of course the US will be dominant, but what do you think there are any economies that will do better and hold out better because they haven't speculated so much? And could ride it out and maybe be an interesting one for the next cycle?
Well, that's a good question. I'm not sure I have an answer to that. Economies which have a huge amount of latent sort of potential of developing very rapidly would be candidates. And I'd sort of look at places like India as an example of that, way behind China at the moment, but quite a lot of things going for it, and it seems to have a government that wants to clean things up. Maybe goes about things in a way that we wouldn't really sort of feel comfortable with or wouldn't accept in the West, but nonetheless is taking quite a strong approach to certain things. So I'd say that, and better connected to the Western world. So there's India. I think there's a huge, demographically, all the sort of growth in population and development that brings is in sub-Saharan Africa, very well endowed with natural resources and so on. And, getting the infrastructure they need, not necessarily always the right policies, but the infrastructure they need to develop. I think that's a longer term story, but I'm sure there's that will be on people's minds as we move into the next cycle. I don't know which of those. It's obviously not going to be true of every single country, but there are some that are, some are going to be very large, like Nigeria. Some are kind of very sophisticated in things like fintech. So I'm talking about Kenya, which is actually where my parents are from. And then, Latin America seems to be quite well positioned between the two hegemons. So China and US. And, again, actually, if you take Latin America together, it has a smaller population, but I think I'm right in saying a larger GDP than China, or it did at least at some point not so long ago. So a lot of potential there as well. I don't know. Again, that's probably not a very specific answer.
No, it's great. It's great.
I think you kind of you tend to see which economies crash the least in the crisis, and their stock market usually bottoms first, and they would be the ones that are going to lead the next cycle forward, or at least have a strong role in it. The US, again, because of its a growing economy in terms of population. It's got a lot of strengths in it's probably the only self-sufficient economy almost. Very easy to get around the US, get goods around the US. Obviously, two oceans on either side, friends on the south and the north, or at least they are at the moment. And very, tech savvy and got a lot of strength. So I think the US will always be a very major part of the cycle. Whether it's continues to be the dominant player, I don't know. Probably won't. Probably be China at some point. But yeah, I think that's kind of my longer term outlook. And actually, maybe might be surprised as well. Maybe the UK might have a role because I think we've effectively wasted this cycle. We've spent the last 7 years arguing with each other and not having good long-term thinking and investment. Maybe it's going on behind the scenes and I don't really know about it. But if you don't have a major boom, maybe you don't have a major crisis. Maybe people think, look, we really need to do something about it, and you get some sound things coming in. You usually get a new change of government at the end of the beginning of a new cycle, brings the cycle forward into the new one. And maybe that we'll find a path forward that we all can agree with. And similarly, I think Japan has also been quite an interesting example. I know that it's sort of seen as a bit of a basket case when you look at it, sort of stock market and so on, but with a quite rapidly shrinking population, its GDP per capita has actually been pretty good. And like you might disagree with economic policy and other things, but from a corporate point of view, I think I'm right in saying they're against borrowing too much, and they have experimented with a lot of new technologies that would be important when you do have demographic issues and so on. It's also a very tech heavy economy, and I think it will also have a role. And actually, its stock market has been quite a good. This cycle has actually been a fantastic investment since 2013.
Brilliant. Tim, were there any final questions?
Nothing to add. Nothing to add.
I just wanted to finish up with the citizens' dividend, because I think we should always take the opportunity to promote that idea that that Phil mentioned in the pod that we did together. Do you want to tell us a bit about what that is for people who haven't heard of it?
Yeah, sure. So I actually touches on the material that I mentioned before about Henry George, and the idea that what causes these boom and bust cycles is the concentrated control of natural resources and land. And actually, this is public value that's privatized. And what we do when we tax people's earnings and business profits is we're taking private value and we're socializing it. So we're kind of taking what people create and we're allowing people to keep what everyone else creates. So it's kind of a very perverse system, and is why we get these cycles of boom and bust. The solution to that would be to stop taxing people's wages and sort of, the benefits of taking risks, and start sort of charging people who control natural resources and land, because, the value of them is by virtue of the public. And what you would then do is pool that into a fund and return it to the public as effectively as a share of their birthright of being in a society, and society being endowed with natural resources. You would get an annual dividend. I think the advantage of that is, it increases economic security, increases fairness in society. And it would also have the benefit of very significantly reducing the size of government, because a lot of what government does is work out ways on how to tax us and check that we're being taxed properly, and having to pay kind of welfare to people who, are at the margins of society. And this would remove the need for all of that. And you see examples of that in some places on actually very significant scale. So probably the most famous example at the moment is the Norwegian oil fund. So they took their sort of the royalties from their North Sea oil fields and put this into the fund, which is now owns, 1% of every stock in the world. Whereas we kind of frittered it away. Alaska does the same thing. I think the size of their fund is about 113% of Alaskan GDP, so very significant. And every year, by virtue of being an Alaskan, you get a check of whatever, $1,000 or something. So these over time can be very, very beneficial to societies. But they also, and the key point is they reflect a fairer way of doing things, which is consistent with, being in a free market and so on.
So the idea being that there would only be one tax, and there would be no income tax, no other tax, no VAT, nothing at all. It would just be a land value tax, and that's it. And it would effectively be equitable across the whole economy.
That's correct. I mean, you may want to tax other things that you regard as unhelpful behaviors like pollution and so on, because pollution is effectively exploiting a natural resource, in this case, the atmosphere's capacity to take your kind of crap. And so you might want to have some charges or taxes on that to compensate people for your giving you an allowance to do that. But yeah, that's the idea. I mean, that's the kind of utopian sort of model. It'd be very hard to, they do pay taxes in Norway, for example, but so I'm not saying that anywhere has done it perfectly, but the advantage of, all this sort of argument we're having at the moment about there not being enough money to invest in infrastructure and something, it's really short-term thinking, but you don't have that argument if you've got a 1.3 trillion pound sovereign wealth fund which earns, I don't know, 5%. I mean, earns a lot of money each year just to fund these things, which then improve the quality of the economy and the infrastructure and so on, make it more efficient and generating more wealth. So these things can work in very virtuous circles and cycles if you allow them to, and it accords with, I think, what people would regard as natural justice, that and any territory has an endowment of natural resources, but they might be concentrated in certain areas. Of course, people who exploit them should earn a reasonable return on capital, but what you tend to find is they generate very significant windfall profits, which really should be returned to the public, and that is the basis to fund what you need in society. And also stop taxing people so much for what they do produce.
Do you think we will ever see something like this being introduced in the UK or in the US?
Well, we almost did. As I outlined in my book in 1909, The People's Budget. Churchill was a big kind of fan of this idea. I mean, not necessarily the citizens' dividend, but the principle of how you rebalance the tax system. That was very much opposed by the landowners, all of whom at the time sat in the House of Lords. And I think the debate has not changed sufficiently to allow this to be a really serious policy proposal. I think, whenever you see an increasing number of articles and discussion about this in public fora. And so I think people recognize that there's something there. I don't know if they kind of see the full picture. And so it's possible we might, start to get some elements of it coming in, whether it's full-blown tax change. I don't see that happening anytime soon, I have to say.
People don't realize how big Henry George was of his time. He was bigger than presidents, wasn't he? And yet he's just been airbrushed out of history. Yeah,
well, I mean, again, a really good book on this is called The Corruption of Economics by Fred Harrison and Mason Gaffney, who I mentioned earlier. And I summarize some of it in chapter 5 of my book, called The Corruption of Economics, out of respect for that book. And yeah, I mean, I think some of the early kind of, say, founders of the economics discipline, I mean, economics wasn't really studied as a subject until sometime in the early 20th century. Before that, it was political economy, and it came out of philosophy and so on. I mean, Adam Smith would have called himself a political economist, I think. And they had a very deliberate, the people who kind of really built economics in the early 20th century, they had a very deliberate aim to ensure that Henry George, who was wildly popular, always became the mayor of New York. And, he was running against people like Teddy Roosevelt, who he beat in that mayoral race, but he came second. He was very popular. People listened to him. It almost made some very significant political changes in the UK. and so on. So he's really someone that they had to pay attention to, but they didn't like his solution. Some of the reasons are that economics faculties in US universities were funded by people like Rockefeller and Carnegie and so on, who were major landowners. And they didn't want this solution because they would lose out. And so they promoted people who found the intellectual arguments against Henry George. And the way that they did it was to essentially remove land as a separate factor of production out of sort of the economics discipline, economics equations, and so on. So you just look at capital and labor. And so you could never propose a policy solution that was just looking at land itself. And when I say land, I mean natural resources and things that generate economic rent. So economics, not only is it incapable of diagnosing the boom and bust cycle, it's incapable of really putting forward a solution to it. It was a stratagem against Henry George, quite deliberately. I mean, I think they're quite open about it in the early years, saying that they don't like this character, they don't agree with him, and they want to amend the discipline to make sure that he's not part of the debate, as it were.
Brilliant. I love the fact that he was self-taught as well. I think that's so interesting.
Yeah, really. Yeah, and this is probably part of it. These people are senior academics and tenured professors and so on. They don't like this sort of upstart who, wasn't schooled beyond the age of 14 and, hadn't gone to university and spent his time traveling around and working on a ship to India and Australia and then had become a journalist and, started pointing out all the inconsistencies and the problems and so on and basically undermining the ruling class with his writings. I mean, you can see why they wouldn't sort of take to that, even if he had something sensible to say. And quite interestingly, Alfred Marshall, the very famous late 19th century British economist. I mean, Henry George was invited to Oxford invited to the UK on a lecture tour in the 1880s, and he lectured in Oxford and Cambridge and all sorts of places. And he was in a debate with Alfred Marshall, who was then at Balliol, my alma mater. And he was really, Alfred Marshall really sort of really argued against him and really sort of was very patronizing in the debate. And I think actually Henry George, who'd been basically lecturing for like 30 days in a row or something, was really, really exhausted and kind of lost his temper or something. I think it didn't look so good. I think the next day he was at Cambridge and he actually did a lot better. And he managed to persuade Gladstone's daughter that he had something to say. And I think she influenced his father, her father rather. Anyway, so Alfred Marshall, I think at the time was a young professor or he's going for tenure or something. And he was against George. But later, I think in the run up to the People's Budget, when he was now the kind of, the grand old professor at Cambridge, I think I'm right in thinking that he had actually changed his tune and was generally in support of the Henry George solution. So it's not none of the arguments are sort of on pure intellectual grounds. There's always kind of this vested interest and looking after your career and so on that has prevented some of these solutions from being implemented. And I think, while people do talk about it more often than they did, say, 10 years ago, I don't think it's ever really been considered in a serious way in a major country. And I don't really see that changing anytime soon because we've got so many issues that have that kind of, issues of inequality, the lack of access to housing, the fact that we go through these cycles of boom and bust in the aftermath of each crisis. You get some really, real social tensions. We saw that with rioting and, the governments enact policies that really do even worse damage, like austerity and other things. And then you get sort of, get fights in society and you get leaders who might exploit sort of people's anger, but they don't have any long-term vision and so on. If you can't, see the obvious solution that's been around for 144 years in this scenario, then, when are you going to see it? Is how I kind of, how I sort of view the possibility of it happening. But the problem is that things at some point can get so bad that you get something of a more revolutionary nature. And you have seen that historically in places. And the problem with revolution is that you never know where it will end up and how much damage gets done before things get better again. So for me, the warning signs are there. Whether people are kind of listening to what people like Phil and I have to say about these things remains to be seen. But I mean, all we can do is put these ideas out there, and hopefully, some will take it up.
Brilliant. So with regard to your media pick, without preempting anything, would it be Fred Harrison's book, or did you have another one?
Yeah, I didn't know I was going to talk quite so much about Fred Harrison, but I should say something about him just because I have, I refer to him a lot in my book, and I have, benefited very significantly from reading his stuff. So I've mentioned him before on this podcast, but for those who've not listened to the previous episodes, the 18-year cycle was probably first discovered by an American economist writing in the 1930s called Homer Hoyt. There might have been someone else as well, Clarence Long, I think the name might be, who'd independently come up with the 18-year cycle. And there was another guy called Roy Weslick. Anyway, they'd observed these 18-year patterns, Homer Hoyt in relation to Chicago, and so on. And then we had the Second World War, and Hoyt himself felt the cycle had disappeared after the Second World War. Fred Harrison rediscovered this in the 70s after the crisis, and essentially resurrected Homer Hoyt and our understanding of the 18-year cycle in relation to the real estate market in a book that she published in 1983 called The Power in the Land. And then he's gone on to write other things about the cycle. He wrote Boom and Bust in 2005, predicting the kind of crisis of the early tweens. Early teens rather, 2010 and onwards. He has also written other things about, how to solve boom and bust and so on. So shout out to Fred. But what I was actually going to mention was, I think Tim, you'll like this. I was in Vienna just before Christmas, and I came across this book with the title Vienna, and it's about all of the very significant intellectual contributions that Viennese scientists and artists have made particularly in the West, in the UK and the US, and they're in all sorts of domains. So art, even in sports, in culture, in science, and also, and you'll like this the most, economics.
You had me at Austria.
Yeah. And so Vienna takes you through the sort of the history of the late 19th century. It was apparently a very open place. People, with the coffee and salon culture, people could go to their sort of favorite coffee shop and listen to, all these really famous people discussing their works and their ideas with the interested people. And it was a great sort of cross-fertilization of ideas and collaboration and so on. So I thought it was sort of fascinating history and had a pretty outsized influence on the world and the way we think about things.
Brilliant. So for a kind of specific media pick, we could put a few of Fred Harrison's books. Would that be fair?
Yeah.
Yeah. Okay. If you had to choose one, which one would you say would be the first one that you'd read?
Well, I think the most important one is Power in the Land, but I think probably the easiest one to read first is the Boom Bust one that he wrote in 2005.
Trying to advise Gordon Brown that there was going to be a crash and he wouldn't listen. I mean, this is, you just couldn't make it up.
Yeah, exactly.
Incredible. Tim, you've been busy buying gold in the background. I can.
No, indeed, gold and silver. Let's not forget silver.
Let's not forget silver.
But mostly gold.
What's your media pick?
I've got 1.5 for this week. So the half is a documentary about crows. It's called Crows, Nature is Watching Us, which is about the historic and cultural symbiotic relationship between crows and ourselves. And crows are very intelligent creatures, as this documentary will show. I think I saw it on Prime. So Crow's Nature is Watching Us is one, and the other one is a repeat. So we've actually had the author on, is listening to you guys both talking about how things have happened in the past that maybe we don't know the full story of. Reminds me of what I humbly submit is the most interesting and intriguing book I've ever read, which is 180 Degrees, Unlearn the Lies You've Been Taught to Believe by Fergus O'Connor Greenwood, which I suggest is the most interesting and intriguing, if not upsetting, book that you're ever likely to read. And I first read it when it came out a couple of years ago, but I've been rereading it lately, and it is the most interesting thing I've ever read. 180 Degrees.
Brilliant. And that White Boy recommendation doc that you gave us was great. I watched it in disbelief. It
makes you very, very angry, doesn't it?
It really, really does. Oh my goodness. Yeah. The dark side of the government. But Akhil, thank you so much for coming on the show.
You not have one, Paul? Go on.
Well, I did mention mine, which was The Ancient Apocalypse, which
okay.
Yeah, but also, of course, Akhil's book. If you've liked the pod, you're going to love his book. So you've just got to get it. Remind us, Akhil, where can people find you?
They can
also, what's the book? Remind us what the book's called.
The book is called The Secret Wealth Advantage: How to Profit from the Economy's Hidden Cycle.
And what's that about?
That is about.
That was a joke, by the way. But
yeah,
like all my attempts at humour, it was leaden and destined to fall to the depth of the earth.
Yeah. No, it was good. So yeah, that's the book. You can find me on X. Handle is Akhil G Patel. And also, if you want to learn a bit more about the cycle, you're welcome to read our free newsletter, which you can access on our website, www.propertysharemarketeconomics.com. It's all one word. And that will give you a weekly update on kind of how we're seeing the cycle unfold. And of course, if you want to take it further, you can become a member of PSE.
Brilliant stuff. Akhil, thank you so much. It's always such a pleasure to have you on the show, and we look forward to hearing from you in the future.
Thank you so much for having me.
Our pleasure. Thanks, Akhil. Take care.
Cheers.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.